The topic for today is the evolution of risks in DeFi. Essentially a space that has varied a lot over time and is still very much in incipient days, but has gone through its ups and downs. So we'll start by going into the metrics that cover these cycles and losses, risks in general that has affected DeFi. And then we'll focus specifically on two of the main verticals for DeFi, which are AMMs. So I guess decentralized exchanges, but focusing particularly on the adaptation of AMMs and lending protocols and what the risks entail for each, how to monitor them, how to manage them, how they've evolved over time. And finally, we'll have a quick section to talk about future trends that are coming and how they're likely to evolve risks over time. So before getting started, quick update from Into the Block. We just have a massive product launch that we've been working on for over a year now. We're calling this product a DeFi Risk Radar, and it's very much in line with the topic for today's presentation. It's about creating transparency and democratizing access to DeFi risks. So these are indicators that are often hard to obtain. Of course, blockchain data is transparent, but extracting this data can be very time consuming and also hard to understand. So we've been partnering with a lot of DeFi protocols and launched the initial version just this week. And in it, you'll be able to access a lot of key metrics tracking these economic risks and how the protocols have adapted to them over time. I'll be referring to a lot of images from that product. And then also on a related note, before the end of the year, we launched a new DeFi exploits dashboard within our respective section, where we have a lot of the indicators that I'll be using throughout the presentation as well. And just this week, we also launched a lending protocols dashboard, where you can have a lot of the DeFi insights into things like the loans these protocols are making, their collateralization, the rates, and much more. So if you haven't, make sure to give those a look. Now let's dive into the main topic. So I've spoken about this in previous webinars, so I won't go into too much depth. But just to make sure we're all on the same page, essentially, DeFi is a brand new stack that creates different risks compared to the ones that traditional finance had. So mainly, technical risks. These are also factored in the traditional finance stack, but also quite different within DeFi. So of course, smart contract risk. These can be exploited. Attackers can find loopholes to be able to withdraw capital from smart contracts. That's a very crypto native risk to consider. And also in terms of like the operational security, the keys of the vaults that hold access to the funds. How is that managed? Is it like just one single address? Is it a multi-sig? What's the setup? That's also an important technical consideration to keep in mind. And then we have another set of risks, which are economic risks, which are perhaps less understood, but equally, if not more important. These can be divided by supply-side indicators, such as the liquidity provided, the demand, such as the loans being taken out in a lending protocol, and finally, some mechanism design principles, such as the oracles that are used, rebalancing mechanisms, and a lot more. That's like the big picture of risks in DeFi. We'll get into these in a lot more detail. And these risks, of course, can be exploited by attackers looking to withdraw capital from the system. These can take shape through economic attacks, which is essentially creating an imbalance to be able to extract capital that you shouldn't have been able to. Hacks, which are, a technical person essentially finding a loophole, a reentrancy attack, for instance, to be able to run a code multiple times and extract capital. And in some of the worst cases, rug pulls, which is an internal developer accessing technical access to funds and withdraw what they shouldn't be able to withdraw. And within these types of attacks and risk vectors, really, we've seen over 58 billion in total losses. This is from our DeFi exploits dashboard, and in this we account for those economic collapses such as Terra, but also a lot of the multiple technical attacks from bridges and many more. The full list of attacks is, by the way, included in the interlog page. And we can see that over time, risks in 2020 in DeFi, of course, weren't so high. Keep in mind that this is a logarithmic axis, so the difference is even more stark. And then, of course, in 2021, as DeFi began getting more traction, more deposits, and also a lot more speculation, the amount of capital lost, unsurprisingly, rose. And in 2022, as a lot of those systems collapsed, the losses reached record amounts of levels with 53 billion lost in 2022, and that amount has gone down to just over $1 billion in 2023. So overall, the track has been decreasing, at least as of last year, but it's still quite high. Excluding Terra, there's still about 10 billion in losses, and of course that has been the largest by far. DeFi collapse, but there's been overall still a lot to consider, and this is a major impediment for institutional allocators to use DeFi, is that a lot of these exploits continue to happen, even if at a lesser scale. In terms of risk composition, we can see here the magnitude and the type of attacks that have happened over time, where each bubble essentially shows the size of the exploits. So we've seen that two of the largest quarters were losses due to economic risk factors, and in general, technical risks have larger losses per quarter, though the two larger outliers have been mostly economic. And there's also a composition of technical and economic attacks that have led to losses over time. We then dive deeper into the underlying causes for these. For the economic attacks, mechanism design is the main principle that has led to losses. So essentially not being able to rebalance properly, minting too much of a token, this type of mechanism that is of an economic nature. Whereas on the technical side, it has been a lot due to smart contract bugs, but also due to private key management, which is arguably even more manageable, for lack of a better word. So you can see here how these have varied over time as well. As I was mentioning, the number of exploits for the technical attacks have been significantly higher, even though those of an economic nature have led to more losses. Then looking by protocols, we can see that algorithmic stablecoins, unsurprisingly, have led to the largest amount of losses. But the most type of protocol that has been exploited the most are lending protocols, which can be quite complex and have seen a wide array of both economic and technical attacks. And also, perhaps unsurprisingly, most of the losses have been unaudited, or at least where auditors are out of scope, which essentially means that they didn't audit the version that was exploited or a feature that led to that exploit. And there's some of the auditors that do a lot of audits in general, like Certic and PeckShield, that have a lot of incidents where their protocols have been exploited, but it also has to do with the volume of protocols that they audit. Over time, we see some key trends taking place with the general evolution of DeFi risks. One is decreasing amount of losses over time. This is due to multiple factors. One is protocols are more battle tested. So a lot of the blue chip protocols have been around for a while now, like UniV3, Curve, Aave, and those have, since they've been going on for a while, attracted a lot of liquidity over time. you can be increasingly sure that they are robust and less vulnerable to attacks. So that has been the case. There's also like a more process perspective to this, that is best practices solidify across the industry, not only amongst the protocols, but also among auditors who look at what previous exploits have done, and solidify how to make a protocol resilient against those types of attacks. And as an industry as well, the understanding of some of these risks improve. So, after a couple of very large scale algorithmic stablecoins, there really isn't any more capital flowing into that category. Therefore, there's less losses because there's less interest by the market. So that's something that has taken time, but it has helped make the market and the loss more robust and the losses smaller. But at the same time, there are cyclical factors to consider, which is why I expect potentially if we enter in a bull market that there might be a bit of an uptick in exploits as people begin seeking yield opportunities that in protocols that they don't really understand or may have not even been audited. Now let's dive specifically into economic risks in automated market makers. So in the crypto early days, we had to rely on centralized exchanges to be able to acquire crypto. This has changed with the advent of DeFi, initially in Ethereum, where automated market makers quickly emerged as the dominant paradigm for trading. And the reason for that is that this type of model adjusts to the constraints of blockchains. So you are not able to, due to the scalability or lack thereof of Ethereum and other blockchains, you are really not able to have a central limit order book where you need to post a transaction to move your asset in the order book from one level to another, post an order. It creates a lot of friction and a lot of costs. So therefore, since the early days, we have had the automated market maker model, which is peer-to-pool. Essentially, you provide your liquidity into a pool, and that pool rebalances with a particular logic, which can vary by protocol. Uniswap pioneered the X times Y equals K invariant, which is the most simple version. But over time, we've had more specialized versions of rebalancing logics for automated market makers, specialized for each type of product that they have. So for volatile pairs, the X times Y equals K variant, invariant has been the dominant one, though now with the addition of concentrated liquidity within that range. And also in parallel, stable asset pairs have used this stable swap invariant pioneered by Curve. So the risks that one has to consider when depositing to an AMM can vary a lot depending whether you're depositing in a volatile pair or if you're using a stable swap pair. These are risks, by the way, mostly from the side of a liquidity provider. So mainly, if you're in a volatile pair, you need to consider your impermanent loss, which is, arguably not the best term for it, but essentially is the loss due to your liquidity providing position not increasing along with the value that you would have accrued if you had just simply held the assets. And this can be because of the rebalancing logic. So if the value of one asset goes up significantly, but the other one in the pool stays sideways or goes down, you end up holding more of the losing asset. So when prices appreciate, your LP wealth doesn't scale as much as the liquidity as the underlying assets do increase, as you can see here. So that creates a potential loss for LPs versus just holding spot. And it also makes profits a lot less predictable. The reason being that you rely on fees a lot for this to be profitable. And fees and volume can't really be predicted. It depends on market activity. And although these have a lot more risks. Generally, the higher return, these provide a higher potential return with higher APYs than stable swap pools. I see a question here on XRP tokens. I'll get into it later since it's not really related to this part. Now moving on to stable swaps like Curve or Balancer, you essentially replace the impermanent loss risk with a depegging risk. So stable coins have, over time, we've seen several collapses, predominantly UST, but also some short-term major depegs in USDC, liquid staking tokens, and so forth. And in theory, even though these tokens are supposed to be pegged to one another, we have seen that this is not always the case. And in some instances, they might not even ever recover. So that's the main factor to consider if you're providing liquidity into one of these. And you can essentially set up thresholds where you consider an asset to be depegged and have potential exit mechanisms. I'll talk about this a bit further. And the other type of risk that you are subject to are pool imbalances. And this has a lot to do with the way that each protocol rebalances. So in stable swaps, essentially, you have a fee when you withdraw your liquidity from a pool, and that fee is a function of the assets distribution in that pool. So essentially, they charge you more if you're withdrawing the asset that's more scarce, and you get paid a bonus if you withdraw the asset that is abundant. So if the pool is supposed to be 50-50, and you withdraw from an asset that has 80% of the pool, you get paid a bit of a bonus, and that's because you help balance the pool from, let's say, 80-20 to 60-40. And that those proportions can be affected a lot by the whale positions. So if one of these whales that has 12% of a pool withdraws their capital, that asset distribution can vary a lot, and therefore your exit fee can be affected, which is why it's very important to not only track at the whale positions, but also the asset distribution and how that varies over time. And in terms of a more actionable, I don't want to say advice because none of this is financial advice, but a more actionable set of things that you can implement. There are exit thresholds that people can set up, similar to stop losses, but for providing liquidity. Users can monitor changes in liquidity, track well positions, and look for hedging opportunities. All of these metrics that have been shown in the past slides are from our risk radar for Curve. So feel free to take advantage of those. They're free to access for everyone. And now let's dive into lending protocols and how their economic risks differ from decentralized exchanges. Excuse me. Similar to decentralized exchanges, lending protocols have also taken advantage of peer-to-pool infrastructures to be able to create liquidity and lending markets on-chain. These have dynamic rates and incentives. So essentially, the more larger the utilization rate of an asset, the larger the fees. What does that mean? Essentially, if there's $100 deposited and $90 of those are being borrowed, in this example with Aave, you would be incurring a 6% borrow fee. But you can see that after this point, essentially the borrow rates increase significantly. So if 95% of the liquidity is being borrowed, your borrow fee would be 50%. I'm not sure exactly that level, but significantly higher, as we can see based on this. So essentially, that creates incentive for people to either repay their loans or add more liquidity to the pools, such that there's no assets being essentially locked up. And through the mechanisms, we've been able to grow and attract a lot of liquidity into lending protocols. But they create a lot of risks, of course, perhaps even more risks than decentralized exchanges. One is at the user level. Whenever you're borrowing, whenever you get leverage, you have the risk of liquidation. And in contrast to traditional finance, here you do not get like a margin call in the old-fashioned way where you have some time to post collateral. Liquidations are automatic, since the protocols don't know who their users are necessarily. So they're fully automatic, and you get liquidated a portion of your collateral. So based on your health factor, which is this formula to model your proximity to liquidation. And another risk is that you might not be able to withdraw. Going back to this formula for the rates, if 100% of the liquidity is being borrowed out, then you cannot withdraw your liquidity if you're a depositor. So that happens less often, but it's still a bit of a tail risk to consider. So at Into the Block, we've been looking at this from a big picture perspective, and we modeled it through this indicator we call health factor distribution, which essentially is the aggregate status of all loans. And you can track how close to liquidations they are. So the positions that have a health factor close to 1 are close to liquidation, while those that have over 2 are, have a significant buffer prior to being liquidated. So this provides an understanding of the whole market status and the likelihood of liquidations taking place, especially if you combine it with additional indicators looking at what collateral is being posted and the whale's position specifically. So like a more detailed version of this. And you can also track the available liquidity. So this is for ETH. It's had ebbs and flows of amounts of liquidity available. So it's important to keep in mind what the available liquidity is, especially if you're a large investor. Say that you have 250K ETH, you wouldn't be able to withdraw at this point, which is less of an issue, of course, for very liquid markets like Aave. But in smaller lending protocols, it can happen to users where there is 100 depositors and a very large whale withdraws their liquidity, and therefore there's no available liquidity, and then you're stuck, at least for the time being. So it's worth tracking these changes in liquidity and as well as the concentration of these pools prior to depositing. And to make matters more complex, in lending protocols, liquidity is generally available across all pools, so it's shared liquidity instead of isolated. There are some newer protocols like Silo where liquidity is isolated for a given pool separately, but in the main ones like Aave and Compound, liquidity is aggregated across the protocol, which makes it easier to attract liquidity, but also creates the risk of being exposed to multiple assets in the protocol. Therefore, if one of these assets, people can manipulate them, you are subject to the risk of essentially what's known as bad debt, which is an insolvency at a protocol level where depositors are unable to be paid back because of loans that shouldn't have been taken out, essentially. This can happen due to two main forms. One is Oracle manipulation attacks, which allow someone to manipulate the price of an asset and artificially be able to borrow more than they should. And essentially, those providing their liquidity do not get their funds back, or at least a portion of them, since the attacker withdrew more capital than they should have been able to. And at the same time, this can also happen due to regular market activity if the liquidation bonus is not enough. So essentially, if it's not profitable to liquidate debt, the debt won't rebalance, and therefore the assets won't be able to be returned to the depositors if the liquidators don't withdraw assets that are going down in price. So that's why it's also important to track the profitability of liquidating collateral in each of these assets. I would say in general, some of these dynamics are a bit more complex for lending protocols. So it's important to understand these. We try to provide documentation along with these indicators because we realize that they're complex. So I would advise trying to understand them, and also, the documentation of the protocols themselves prior to depositing assets. It's also worth looking at the exposure to other assets within these protocols, as I mentioned. So if there is a very small cap asset, meme coin with $5 million market cap, in the pool, sharing liquidity with USDT, USDC, and all of the blue chip assets, those large assets are still at risk of being in the same pool as the small caps that can be manipulated. So that's definitely worth considering. And you can also track your own individual liquidation risk and available liquidity to be able to make sure you're protecting your capital. Now, to finish this off, I want to share a bit more of the trends that are coming into DeFi and shaping this next iteration for the coming years. One is we've seen the dominant DeFi protocols expand beyond their initial use cases. So, for instance, Aave started as a lending protocol, and now they launched their stablecoin. Curve as a DEX, and they also launched their own stablecoin. This introduces new risks, and in some cases can even make the risks stack on top of each other. So, for instance, CRV-USD, both CRV-USD and Avigo are listed in their own platforms, which can make the risk of one transfer into the other. So it's worth considering these two both individually and in aggregate, and what they can bring to the protocols. And on another side, we're also seeing vertical expansion from protocols like DYDX and Uniswap, moving closer towards the users. DYDX in the form of launching their own chain, so that users interact with the DYDX chain instead of Ethereum or whichever chain. And because of Uniswap, they opted to launch their own wallet, where users hold their funds in those wallets. It's non-custodial. And they have that closer relationship to the user. In doing so, however, these also create technical risks to consider. So it moves from being like just a regular DeFi app to more of an infrastructure play in the case of DYDX and Uniswap. And then another trend that we're beginning to see, since 2023, but will likely materialize in 2024, is the launch of micro primitives, as coined by our CEO, Jesus Rodriguez. Essentially, these are components within these protocols that are abstracting away a lot of the logic and making it such that users can create more advanced functionality on top of a basic framework. So the perfect example of this is Uniswap before hooks, which essentially Uniswap creates that logic of being able to trade, and on top, people that create the pools are able to customize, how the fees vary over time, how MEV extraction can be adjusted, a layer of extra customization where people can compete in a way to create their own, more specialized use cases on top of the base layer of liquidity. Morpho is also doing something like this for lending protocols. And another aspect is EigenLayer, which is creating like a micro primitive for staking, essentially. So they're taking staking from Ethereum and being able to generalize that trust such that application validated services, or AVSs, on top can have the trust of Ethereum, have that end security, while spinning off their own application and focusing on that. And that is also creating this new market called liquid restaking tokens, LRTs, where people can have access to these extra yields that these AVSs have, and be able to use them as another piece of financial Lego on top of DeFi. All of these create a lot of complexities, especially the micro primitives, that are important to keep in mind. It's hard to grasp all of this, of course. So we at Intoblock will try to have more information of this. We're in discussions with many protocols, and ideally have more transparent outlook on the risks that each of these protocols have to be able to monitor DeFi in a more transparent way. In conclusion, DeFi has been trending towards being more secure over time. I think this is good news, and it doesn't get enough attention because you still hear exploits happening. Of course, that will continue to be the case. But in terms of magnitude, they have been trending to be lower and lower exploits over time. Technical risks happen more often. That being said, economic risks have been more severe historically. They are also more mitigatable and easy to monitor. So that's the main reason why we're focusing on economic risks and into the block. AMMs and lending protocols, as we discussed, provide a new alternative to existing traditional finance system, but also a new set of risks. So it's important to consider these and understand them over time. And finally, it's worth considering that DeFi still is in the early stages. So we're likely to continue to evolve as some of these new primitives we discussed gain traction and adoption over time. Thanks everyone for tuning in. Next webinar will be very related to what we spoke, but more from a return perspective than a risk perspective. So we will be discussing what is new and interesting in DeFi. A lot of the subjects that I alluded to within the next phases, we will discuss those, as well as new ecosystems launching, liquidity mining campaigns, some interesting opportunities that are emerging for anyone that follows the DeFi space closely. So make sure to sign up. The link is available in the chat there, and I'll be sticking around for a few minutes for questions.